As the banking world turns, I'm Al Dominic coming at you from Washington, D.C., while my co-host Steve Williams attempted to steal my normal studio seat in Scottsdale, Arizona before retiring to his office. The two of us are delighted to welcome an expert on banking regulation, on risk management, and on fiscal policy. You know, with so much happening in the world today, we were really thinking about who we could invite for this new episode of Plugged In, and we called, and lucky for us, Gene Ludwig answered. For those of you who aren't familiar with Gene's career, this is someone who served from 1993 to 1998 as Comptroller of the currency. He founded Promontory Financial Group. He served as Vice Chairman of Bankers Trust and Deutsche Bank. Today, he's the Chairman of the Ludwig Institute for Shared Economic Prosperity. He's a co-managing partner of the venture capital firm Canopy Ventures, and he's the CEO of Ludwig Advisors. So yes, he's a man of experience, perspective, and, dare we hope, some opinions. Truly a fitting guest for this latest episode of Cornerstone Advisors Plugged In. So, Gene, thanks for joining Steve and myself.
Well, this is great, Al. The only thing I can say is that introduction was so over the top nice that I'm going to make sure that my office records it so I can play it to my two daughters and son, who will not believe a word of it. But at least I'll have competitive equity next time.
That's Dad, right?
That's Dad. That's Dad.
Well,
that can't be Dad.
It's now memorialized for posterity, so it's there, and that puts it on record. So there we go, my friend.
I won't give them a path to your door or something.
Well, look, Gene, you've been someone who shared the stage with both Steve and myself at various points over the last few years. We've had opportunities to look at how different factors shape our great industry. And for Plugged In, what Steve and I have tried to do is take another great industry and pull it in, and that's the music scene. And so we pulled 5 different tracks that we could ghost against for our conversation today, because we are talking about the business of banking, but we have folks like John Mellencamp, who wrote Authority Song that really gives a nice lead in to talking about some of the congressional matters. So if you're not familiar with John Mellencamp, I'm going to put this on the Spotify playlist that we've created for Plugged In. He's got some lyrics that say, they like you to go in a compromising position. They like to get you there and smile in your face. They think they're so cute when they got you in that condition. Well, I think, and we think, it's a total disgrace. So Steve, I'm no John Mellencamp, but for that lyric, let's talk a little bit about the House and Senate. What would you like Gene to focus on?
Yeah, well, Gene, I think it's, given all your experience, and really you see the entrepreneurs out there trying to do interesting things, transforming financial services. And now you see the navigation of a lot of macro policy and incidents right now in the banking industry. So if you could advise the Congress on smart policy to deal with what people are saying, we need to do something about this. Is there anything that needs to be done from the congressional standpoint? What would you advise Congress to think about as it relates to addressing what's happened recently in the banking world?
Well, Steve and Al, it seems to me there are several things that Congress ought to be exploring. Number one, and it's not necessarily in this order of priority, but let's say number one, they have got to make sure that the government, our regulators, the executive branch, have tools that can work in a crisis swiftly and without having to have complications that we now have as a result in part of Dodd-Frank. I mean, one of the things that Dodd-Frank changed, which it seems to me was a step back, not a step forward, was making it very complicated for the FDIC, the Fed, the Treasury to act promptly in a crisis. That's number one. Number two, we've got to explore having a more robust deposit insurance system. It's crazy to have a $250,000 limit. That limit ought to be much higher. Maybe it ought to react more like a real insurance company where people can buy the amount of insurance their institution needs. So if you're going to have bigger deposits you want insured, you pay more. If you're a smaller institution and you don't have all those big deposits, you pay less. So that there's some proportionality here, but a system that really is appropriate for the time and place we are today. The third thing I think that we ought to be exploring is giving the regulators new tools to be able to deal in the modern day where we have a big change. We've just seen a big change as a result of this crisis, but it was brewing. It's a technology change. We are living in an immediate media world.
That's right.
We want our payment systems to be rapid fire and same day, real-time payments. We want our internet to be something that we could converse over instantaneously. And all those factors make speed, a real factor in how you do financial services and how easy it is to attack a financial services institution. We have to have regulators with tools to be able to deal with that. For example, one thing that we ought to be exploring is a way to unplug for a few hours, a circuit breaker or some other mechanism that give the regulators and the public time to act. Otherwise, people take advantage of these situations. Short sellers, people can manipulate the market, people lose. Right now, we have regulators having to utilize tools that were created too long ago.
Yeah, and really interesting, I think, is the point about assessment could be risk-based as assessed by the FDIC. Now, not necessarily private deposit insurance, but you're saying just a risk-based system of its deposit insurance to expand past the 250.
Yeah, so private insurance does not work. We went through that period 10, 20 years ago or longer. No. There must be FDIC insurance. That's why we put it in place in the 1930s. And it worked rather well to avoid contagions, which have been a history of American banking. But it worked well. But it's outdated in the sense that it's not prepared to respond to the realities of this marketplace. I mean, it's insane that one of the reasons that apparently that these institutions were attacked is because they had uninsured deposits. Because for business banks, they're always going to have uninsured deposits, right?
Right.
Business banking, if you have a business account, it's going to be bigger than $250,000.
So, Gene, as you're talking, I'm just jotting a few notes down. As I said, we're using some music. I'm going a little bit sideways when I think of Pete Townsend when he was writing for The Who. He said, we meet the new boss, same as the old boss, and that's for the song We Won't Get Fooled Again. And I just thinking about that because you're talking about some
you're on your game.
I'm trying
to be your game.
Look, just tell your kids if they need a DJ, I'm available on Fridays. But, I'm just thinking about these tools that banks and regulators could be developed because you, I believe, shared something on LinkedIn recently, which is a pretty creative analogy about the space that we're in and, the time that's needed. I think you said something along the lines of a fireman being called in to stop a wildfire before it spreads, and that she or he doesn't have time to convene a committee and vote before dousing it with water. And so we're talking about banks and regulators developing new tools that might address new problems. Can you elaborate on where you think more time and effort should be paid by both sides?
Well, absolutely. First, it is the nature of tail risk generally that I think is worth focusing on. What happened with SVB and Signature are really tail events. They were unanticipated. It's not, everybody's pointing a finger at these holdings of treasuries in the held to maturity account. That's a part of the story, but I think a much smaller part of the story than people realize. In fact, there are all kinds of tail events that can happen to you, unexpected events. Nobody had expected when they created these accounts, when they regulated these institutions, that things would happen as instantaneously, as rapidly as they did. That wasn't anticipated. And the secret to dealing with tail risk is to cut it off the second the tail is expanding. I've dealt with tail risk matters in finance most of my professional career because there's always the biggest risk, the biggest dangers. And what I've learned is they don't just explode. They fatten out over a period of time, can be short. But if you can take action quickly, you can cut them off and really save the situation. But that means you have to act quickly, particularly in today's day and age, which, as I've said, is so moved by modern technology, by in all kinds of different ways, payment systems,
Yeah.
the internet, et cetera. And right now, for a lot of the things regulators could theoretically do, they've got to basically have committee meetings by law and by practice. They've got to get together and have the Federal Reserve Board vote, the FDIC board vote, get together and jointly agree, go to the Treasury Secretary, then even in terms of some of this, go to the president, and finally, if they have a real contagion, they got to get a vote by both houses of Congress. Just imagine a fireman basically having to put out a fire going through that rigmarole. All of California would have burnt down.
Yeah, that's really interesting about cutting the tails off.
Oh, Steve, are you trying to bring some music into this? I would love to throw it your way so that you could be part of the DJ committee that Gene is hiring for his next get together.
Well,
I'd like that.
This is very hip. I got to say, I hadn't expected this. I thought this was going to be
trying to bring a little sound effect to the table, right?
Hip, yeah.
Well, was that sound effect? I can see clearly now.
Yep.
By Johnny.
Yes, it was.
Because wouldn't it be nice
about the future of banking? Johnny Nash, I can see clearly now the future of banking.
Well, if we're talking the future of banking, maybe we could talk about some of the building blocks of a smarter bank or that next wave of top performers. What do you think are some of the key elements, Gene, that go into making a strong and smarter bank in the coming years?
It's in part, it's both the old and the new.
Right.
But let me focus on the new. You can't have a smarter bank in the future if it doesn't ingest modern technologies promptly. The only way to deal with the reality of a marketplace that has become speedier, that has become a more competitive, more global, more technologically driven itself, is for you yourself, your own institution, to have modern technologies that can both protect you and also give you competitive advantages in the marketplace. And so ingesting those technologies promptly is very, very important. But the other part of this, when I said it's a little bit the old and the new, we have to have people that are excited enough to join banking that have been at the quality we have historically have and have today in the banking industry. We have top people in the banking industry, and historically that's been a great advantage to the American banking system. And people at top people at institutions of different sizes and shapes that can deal with the public in different ways all over the United States, and one that's been, in its own way, a happy, blooming, buzzing confusion. People can start new banks with new ideas. People can, do banking a little bit, in a specialized way for their own customer base. We've got to be able to attract these people, and that means we've got to have regulation. Of course, we've got to have smart regulation and regulation that does not overburden the system, such that we have a system that is heavily regulated. They can't deal with these regulations. You're dealing with them all the time. Where at the same time, your competitor next door has no regulation, doing the same thing. Now, when you asked me the question earlier, what are the things that Congress can do? I failed to mention number 4 on my list, which again is not way of priority. Non-banks doing the same thing as banks need to have the same regulation that banks do. We should not have a situation where you have entities doing the same activities at the same size. One's regulated heavily, one's not regulated at all.
Can I get an amen?
Well, yeah, Gene, I've heard you say this: regulate by activity, not by charter, and I could not agree more. And with data today, I mean, if we can get a better data infrastructure across the industry that is more real time, and that was not the case with, as I understand, some of SVB's data, but smart regulation could be driven a lot by analyzing data across the whole system. And to your point, grabbing the tail before it grows too big. So I think there's a real opportunity to have a data strategy around regulatory oversight and looking for where risk pops up because we can never predict it.
Steve, that's very smart. I couldn't agree with you more as you've articulated. Absolutely. We need a broad data strategy. But I'll tell you, there's a danger here. We're going to be fighting last year's fighting it incorrectly. The notion that the problem here was banks that were specialized or banks that had utilized the held to maturity account in and of itself. Yes, you could make choices and changes, but it really wasn't that in and of itself. The big thing here was speed, a new kind of tail risk, and neither the regulators nor the institution had the tools to react quickly enough.
Hey, Gene, the Economist kind of ticked me off in the last week because they talked about reciprocal deposits, and you've been a visionary with Promontory and now IntraFi. They used the term depositors gaming insurance, and that really ticked me off because to me, a reciprocal deposit system for community and regional banks, to me, makes a ton of sense to create that dynamism and vibrancy that you talked about, diversity in the industry. What do you see next for a growing reciprocal deposit network in America?
Well, I think it's a good thing. In other words, obviously, I'm proud of what we did. And it's really hardly gaming the system. It's simply just making the system more efficient. When I came up with the idea, it was both easy. On the one hand, I saw community banks of all different sizes and shapes and communities they were serving, but that couldn't get enough deposits. They couldn't compete because the big guys would say, well, how could you dare bank that thing? They're not big enough and whatever. And this gave the community bank competitive equity. And on the other hand, I remembered my Aunt Betty Chadwick, God bless her. She was a secretary in Philadelphia, Pennsylvania. And she, in those days, in her day, the deposit insurance cap was $35,000. And she had a little bit more than $35,000. Maybe she had as much as $300,000. But she went from bank to bank, getting enough insurance at each bank that put her deposit below $35,000, so enough insurance coverage that she felt secure. And so she'd have to get on the bus in Philadelphia and go from bank to bank to bank. That's perfectly legitimate. That is legal. That is permitted. It's a long-standing okay by the FDIC and the government. And the only thing that reciprocal deposits actually does is allow Aunt Betty the opportunity to go to one bank and get that service provided to her by the one bank. And what's wrong with that? They're acting as her agent to do this. And frankly, for Aunt Betty, it would have been a godsend because I think she died and a bunch of her accounts were lost because she couldn't got it up in years, couldn't remember all the banks she went to. It's ridiculous. This is a version of the system in a lot of ways as it was intended, but in a modern fashion.
That's right. And I think banks would be smart to double down on making that customer experience even better through the digital world, through mobile. I can see, where my IntraFi is and make that really fit today's world. I think it's exactly what the customer would want.
Yeah. I agree. And respect The Economist. I read it, but I think on this one, they got that wrong.
What do you got next, Al?
I was going to say, having worked alongside folks at The Economist years ago, it tugs at my heart to hear you upset, Steve, but I understand. I agree with the points that you're both making. Now, we've talked about Gene's aunt. So what if we looked ahead in the future and people in your family, Gene, was looking back on Uncle Gene back in his day? There was opportunity to do some stuff. Did they do it or not? And we're living in this time where, fintech continues to rise and fall. And last year, Steve, we had some great interns working on some DeFi projects that I think still has merit. So I've made note that Gene has predicted that fintech and DeFi will be integrated into the regulatory story of traditional financial institutions. And you think this presents a great opportunity for banks. So again, if this is looking out in the future and your family is kind of having that retrospective, how have banks been able to pursue this opportunity?
Well, to date, it's been okay. In other words, unfortunately, DeFi has gotten mixed up with the term crypto. And the regulators have turned their face away from crypto of late. Now, I find this both amusing in a couple of different ways. Not amusing if you're in the business, but it's amusing in a couple of ways. One, if you're going to pick up a term and the next time to sell your product, don't pick the term crypto, crypto is like a Darth Vader idea. In other words, it sounds illicit on its face. Come up with a better term. The second thing about quote unquote crypto is it's been used so broadly and misunderstood. DeFi is not crypto in and of itself. It can be used, it actually cover the blockchain mechanism, distributed technologies for accomplishing all kinds of tasks, including non-currency tasks like smart contracts. So there's tremendous opportunity here. For the regulators really are going to have to differentiate between what they mean here, so that they don't basically block banking out of a lot of legitimate activities. But the other thing I think here is very important. It goes back to this same activity, same regulation. If the United States has turned its back on cryptocurrency, okay, I'm not going to sit here and argue in favor or against cryptocurrency today. But I do think if that's the way it is, then it should be true for banks, and it should be true for non-banks. It shouldn't just be true for banks. In fact, it's a little odd today to exclude banks when banks actually can be regulated in terms of what they do with crypto, and the non-banks can go willy-nilly. It's a Wild West show. So that seems to be particularly nuts. And there is a huge danger here. Keeping banks out of things that are modern and advancing will strangle the banking industry, and it will hurt America. Now, it will not be durable over time. This whole business of having these big non-banks and the supposedly walled off and therefore safer banks is not going to be able to exist over time. It will create an explosion because if either regulation matters in terms of increasing safety and soundness, or it doesn't. Presumably it does. If it does, it means what's going on out there in the non-bank land isn't safe, and something will happen that is explosive, and then we'll get back to our senses. But ideally, we won't have to wait until something happens, and we'll have a real competitive level playing field, which they should have.
I always say about this stuff, go back to James Madison. If men were angels, we wouldn't need all this, but they're not. And I think what 22 proved, Gene, was institutions of trust have a place in our society, and things like oversight and governance are there for a reason. And I agree. If let the modernization come to the industry, but support institutions of trust that have governance, that have oversight and smart regulation, and you're going to end up with a better vibrancy without as much volatility for the economy.
Amen, brother. Amen.
You and I are good friends, but I like you're thinking James Madison you're listening to Gene. I was thinking Huey Lewis and Huey Lewis in the news, because he's saying crypto needs a new name. I just want to play I Want a New Drug. I feel like that's the soundtrack for this particular part of the podcast. So, I'm having more fun probably than I should when it comes to music selection today. We've got one more question, Steve. I'm going to let you talk stress testing. I don't know if you have any track in mind that could line up with using stress testing as a more strategic tool than just a compliance one, but
well, I hear the bass line of John Deacon from Queen, boom, 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 and it's probably under pressure. I talk to CEOs right now. They're wondering what the next 50 Act circular on liquidity stress testing is going to look like. Obviously, there was a stress test model fighting the credit risk war when then this came along. And to your point, it wasn't just liquidity risk. It was liquidity risk put on steroids in a new digital world, Gene. So what do you think is going to happen next for banks in terms of stress testing? And if you were going to give a CEO advice, how should they set up a stress testing capability that isn't fragile, that's not fighting the last war? Have you seen banks do this well?
Yes, actually. But before I get to answer your question, I can't help myself but go back to refine the prior comments and question on crypto. Because you, Al, analogized crypto just a moment ago to a new drug in terms of your mind. And there is no doubt that you have to be skeptical, particularly if you've been a former controller of the currency, to people inventing a new kind of currency that nobody's regulating and nobody's controlling, and somehow people are basically putting their money in it, particularly folks who don't have the money to do it. You can't basically look at that as an unregulated thing and feel good about it. But my point about crypto is that term has been used so willy-nilly that it covers not just that activity, which we're all skeptical of, but all kinds of other DeFi blockchain activities that really, are not about currency and nor about necessarily non-regulation. So just to make that distinction, I'm not advancing cryptocurrency or your new drug, hardly. Now to stress testing. Yes, I have seen it used well, and in a sense, I know a number of U.S. banks do this, but I was first impressed years ago when I was dealing with the board of directors of the National Australia Bank in about the year 2000, when we were in for a project. I was then my creation Promontory Financial Group, in to create a project there to help them out with something. And the board of directors had an offsite to do stress testing, which they called scenario analysis. Look at the possibility, the range of things that could happen, and how would this affect our bank. Interestingly enough, by the way, one of the ones that the board wanted to review back then was a pandemic, which I thought very odd, to be honest with you. But if you're in Australia and you're so close to China and Southeast Asia, it makes a little bit more sense to be worried, I think, about that than I'd appreciated coming from North America. But in any case, they were right. They were a couple of decades early, but they were right.
Yeah.
They were quite prescient. But doing it, they were serious. They got into it, et cetera. I was naive in a way because I assumed one way or the other, every bank was doing this on their own. It's something I did when I was at Bankers Trust, is look at scenarios, different scenarios, and have our people go through how they would affect the bank, including things that were more like tail risk events. Every bank should do that on their own. We shouldn't have regulators requiring it. And frankly, having banks do it on their own, within maybe some loose set of rules, or do it every year, or do it seriously, is, I think, even better than a CCAR analysis that's a government, organized stress test. But I'm not against CCAR. And I think CCAR and the fact that Dodd-Frank focused banks on having stress tests is fundamentally a good thing. But it, number one, should not crowd out banks doing it on their own. And number two, it's not necessarily the be-all and end-all, because you can't come up with one stress scenario. And that's, very much what I worry about, that is going to be right all the time or cover all the possibilities.
Yeah, I think no matter what the regulation, what you mentioned, the culture of a bank should be one of data-driven debate all the time, and creating scenarios and saying what if. And I think what I always say with directors, I might not be the most technical banker if I'm on a board, but I can ask scenario questions, and management can have to answer those with analysis and facts. So I think that culture of debate is hugely important when you're in the risk business.
Yes, Steve, that couldn't be better said. The culture of debate, I often like to call it, like the Comptroller's office does, sort of critical challenge, or a challenge function. But you put it quite well.
Well, I would think that, Gene, you put a lot of things quite well for us today. So Steve Williams and I just want to send our appreciation for joining us on this new episode of Plugged In. We'll be catching up with more folks in the coming weeks. We encourage everyone to subscribe to their favorite platform, wherever they choose to get their information. But again, on behalf of Steve, I'm Al. Thank you, Gene.
Yeah, thanks, Gene. Really love the discussion.
Thank you very much. Honored to be with you.